Okay, I've been hearing a lot about, oh no, the Fed's raising rates. It's going to kill the housing market. How horrible it is, and what the actions of the Fed do to mortgage rates, and it's simply not true. So I brought in my mortgage expert, Ken Pitts from First Choice Mortgage Advisors. Hey, Ken.
Paul, how are you?
It's Monday. It doesn't get any better than this. So, Ken, talk a little bit about, I guess, the myth understanding about how the Fed does or does not directly impact mortgage rates, and what is the correlation, if any, and what really does impact mortgage rates.
Okay. So ultimately, mortgage rates are always determined by the supply and demand in the mortgage-backed security market as an investment. If investors want long-term interest rates to invest into, they buy mortgage-backed securities as one of those investments. Sometimes they buy municipal bonds, sometimes they buy corporate bonds. Mortgage bonds are a similar long-term fixed rate investment. So generally, that's our supply and demand, okay? The supply of mortgage-backed securities is dependent upon the market, how many people are buying homes, how many people are refinancing. Those are all generating mortgage-backed securities. And the Fed, their moves, whether they're raising or lowering rates, how they impact the long-term fixed rate market is really depending on how they're trying to impact the economy with these moves. So if you look at today, for example, what's going on with the Fed? The Fed's raising short-term interest rates. Their goal in raising short-term interest rates is to curb inflation. Inflation is the kind of the antichrist of mortgage-backed security investing. Who wants to invest long-term dollars at a 6% rate or a 5% rate when inflation's running at 8%? They're losing money. So when the Fed, in this case of the time period we're in now, they're trying to curb inflation. If they're trying to bring inflation down, that makes long-term investing more appealing. If it's making long-term investing more appealing, the demand for mortgage-backed securities goes up and our interest rates go down. It's still a supply and demand issue. Just like housing prices are determined by supply and demand, the interest rates are driven by whether investors want to invest long-term or not. And by the Fed trying to curb inflation, they're trying to make it more attractive for investors to invest in the long-term and long-term bonds. That helps us. And you'll notice that if you look at the 10-year Treasury and you look at the 30-year bond, both are considered long-term investments. And we generally will mirror each other. So if the rate on the 10-year is going down, you're going to notice that the rate on the 30-year is going down. There are some instances where we uncouple, and you'll see a little bit of abnormality. If you look really closely at the graph, you might see where the 30-year took an extra drop and the 10-year didn't drop as much, or the 10-year dropped and the 30 didn't as much, and it closed the gap. But ultimately, if you look at this graph you have up, the 10 and the 30-year are two long-term investments, and they are somewhat coupled together. And it's a good indication of how long-term rates are looked at. And if the Fed is trying to do something to make long-term rates more attractive for investors, like fighting inflation, you'll see that interest rate moves that the Fed makes for the short term help us out on long-term investment. Now, with that said, the Fed on the U.S. Treasury on their books, they own a lot of mortgage-backed securities as investment. And they're getting ready to unload some of those into the marketplace. They've been doing it a little bit so far over the last few months, but if they oversupply the market, rates are going to go back up. So they're pulling two different levers right now. They have the interest rate lever for the short-term rates, and then they have dumping supply into the long-term fixed rate market by unloading some of their mortgage-backed security portfolio. So they could, in effect, bring rates down and then slowly bring them back as they unload portfolios. So that remains to be seen, how they're going to do with how the absorption rate is for the long-term rates when the Fed starts to unload some of these bonds. But for now, I'm all for the Fed raising rates. As they're raising rates, it's helping the long-term interest rates. And so anybody that's looking at a 30 or 15-year fix, the rates got better since the Fed moved a week ago, or 2 weeks ago almost.
So that's great. I mean, that helps a lot. I'm seeing more and more headlines about things like adjustable rate mortgages and some of the other loan products out there trying to get cheaper loans. And I know you and I were talking, I was thinking the other day that maybe a 7-year ARM might not be a bad investment or might not be a bad choice, simply because over the next 7 years, we'll have time for the rates to go up, inflate, the Fed rate, the economy will have time to go into, say, a 2-year recession, rates will come back down, and maybe that would be a perfect time to refinance. But you're saying that's maybe not such a great plan. Could you talk a little bit more about that?
Yeah, and that brings up a really good point. The 7-year ARM is probably the adjustable rate that we most often recommend because it gives you time, right? It's generally priced better because it's on the shorter term, 7 years, but it gives you enough time for rates to run a cycle. And generally speaking, ARMs are recommended when interest rates are high. So as we approach 6%, 10 days or so ago, we were looking at ARMs as a way to go. But remember, an adjustable rate mortgage is a shorter term product. Even though it might be amortized over 30 years, it's invested as a short-term product, not a long-term product. It's only 7 years. So when the Fed raises rates, it affects the short-term products. And so the 7-year ARM, we try and look at a spread between the 30-year and the 7-1 ARM. And if there's a generous spread between them, we recommend the ARM. When that spread narrows, we go back to recommending the fixed. And we're kind of looking at the fallout of that right now since the Fed made their interest rate move when they hiked up. It started pushing the short-term stuff up and the long-term stuff down and narrowed the gap. And so the ARMs aren't as, exciting of a product to look at right now. Now that could change if the Fed starts to unload a lot of mortgage-backed securities and they oversupply the long-term market. Those ARMs could come back into vogue again. But it is a good hedging. I call it a hedging tool because you could take a 7-1 ARM and you can wait out a recession come through. The Fed always lowers rates going into a recession, trying to re-stimulate the economy. That's when you grab your refinance for the long term.
Got it. Okay. So if somebody were to get, I know we're working with buyers now we're still looking at 30-year fixed. They always have the option of refinancing when rates go down to another fixed rate or, to another loan product, whatever is working at that time.
Mm-hmm. Yeah, you can always refinance your rate. There's no waiting period on that. Some folks think you have to wait a year or 6 months. You can refinance whenever you want to. It's just got to make sense financially for you to do it. So you have to have enough of the rate drop so that you can recoup your closing costs quickly enough to make the expense of doing the refinance worth it.
And then the other question that I'm hearing pop up from buyers is about buying the rate down. Does it make sense to start buying the rate down or pay points?
I'm going to say it can. Okay. So what we look at in the marketplace is what's called a spread. So if let's say, for example, 30-year fixed rate mortgages are at 5.5, and we can look at what 5 3, they run in eighths. So we look at 5 3/8, 5 1/4, 5 1/8, 5%. You can pay points to discount the rate, to bring that rate a little bit lower. We always want to look at the relationship of what does it cost versus what you save, okay? Generally, to move your interest rate down an eighth, it'll cost you 0.5 point or 0.5% of your loan amount. So for example, if you had a $100,000 loan and you want to move your rate down from 5.5 to 5 3/8, it's going to cost you $500 to do that at settlement. If you wanted to go to 5 1/4, it's going to cost you $1,000. 5 1/8, it's going to cost you $1,500. So what we want to make sure is you're saving enough money on the drop down to make it pay off for the points that you're paying. Sometimes the spread narrows and that you can move 1/8 of a point and it only costs you 0.25%. That's a great buy. I would recommend paying points in that market. Sometimes the spread widens and to go down 1/8 costs you 0.75 of a point. I'd say, no, it's not worth it. So we look at the spreads, how those mortgage-backed securities are trading at each interest rate to determine whether we recommend points or not recommend points.
And then that figures into how long is it going to take? How long do you want to own the house versus how long is it going to take you to recoup that cost?
Exactly. And it's typically about 4 years. So if it's a 7-year house for you, you're probably at break even almost. And you might do better just sitting on the money. If it's a long-term hold for you, a 10, 15-year hold on the house, paying points could make sense in the long run.
Got it. Okay. What else is happening out in besides rates going up? What are you seeing on your side as far as like demand? Because one of the things I've seen a lot of confusion. Rates are going up. Oh no, rates are going up. The market's going to tank. Buyers are getting all excited. They're just waiting for prices to drop. And then the very next slide, we're seeing fewer houses are selling, but prices are going up.
Well, the inherent supply and demand issue that's been in the market for going on almost 4 years now, that's not going away anytime soon. The population of people that want to purchase versus the population of people that want to sell and homes available, because especially after the last 2 years, there's been a real curtailment in new construction builds because of just supply of product. What we're seeing is that demand is not going away. It might be leveling off some because interest rates knock some people out of the market and they can't afford the house that they were looking at before. And they're going to have to wait either until they get a raise in income or interest rates come down to make it more affordable for them. So we've seen, look in the markets where you and I are doing business. A year ago, you could put an offer in and you're up against 20 offers. And now you might be up against 5. So the competition for every particular house has gone down. However, they're still getting multiple offers on houses. And as a result, it's supporting price levels.
Got it. So demand is still strong enough to outweigh the effect of the increased prices, or the increased prices and the increased cost of money.
At least in our area, geographically, the greater Philadelphia market, out to Harrisburg, up to Allentown, and down through Delaware, and all of New Jersey is like that in those markets, and that in our tri-state area. They're all pretty much the same. We've seen some slowdown. I do work in Delaware. I've seen the southern part of Delaware, the competition has backed off. One of the other positives to that is there's more seller acceptance of things like FHA loans. I just had a USDA loan accepted. These are generally, they were generally third-class citizens in this last couple of years. Everybody was just doing conventional or cash. Nobody wanted to talk to you if you were trying to do a government-backed loan. And luckily, people were sensitive to veterans and still were accepting VA-backed mortgages. But FHA and USDA certainly were shut out for quite a while, where sellers just wouldn't accept that type of financing. Now they're getting a little more flexible.
That's good to know. So, okay, Ken, I think that's it. Anything else that you want to get out there?
Just, my personal opinion is it's still a good time to buy. The demographics are telling us that demand levels will probably continue to run, where demand's going to outrun supply here for the next few years. If we hit a steep recession, that could change the numbers some, but in general, it still looks like demand's going to be strong. So you're better to buy now than later.
And as long as you don't have to sell right away, any loss, if the market should happen to decrease a little bit, then it's just going to be a paper loss and you're not going to realize it until you sell. As long as if you're looking at least a 7 to 10 year horizon, you should still do okay.
Yeah, average across the United States was almost like a 34% increase in value over the last 2.5 years. Everybody's living on a paper gain right now. So if the market happens to slough off some when you go to sell, that's gimme money. That was free money. You're still living on free money.
Yeah. Okay. As always, appreciate your time, sir. Thank you. And we'll stay in touch.
All right.
Thanks for watching the video. I'd love to get your comments on it and hear your feedback. So do me a favor and leave a comment down below. I'd love to hear what you have to say. Also, please don't forget to hit the subscribe button. There's more good information to follow. Thanks again and have a great day.